welcome back to the YISF event this year. Hopefully we'll be in person next year. And as you're all joining, let me just say, Sarah Bloom Raskin, welcome to Yale.
We're happy to be here virtually.
For the attendees, check out her wealth of experience at the U.S. Treasury Department, the Financial Reserve Board, and also congratulations on your recent appointment at Duke.
Thank you.
So let's get right to the topic, if we could, which is climate-related financial policy, the way forward. What do you see as the role for climate-related financial policy in the overall policy mix as we speak?
Well, yeah. First of all, thank you, Cary. I'm like thrilled to be here as part of this discussion and conference. And the timing of it, of course, as we all know, really could not be better. We are here at the cusp, really, of the COP26. This is a defining moment for countries and governments and firms to really be converting their convictions into conduct. And, Cary, to sort of ease into your, the answer to your question, let me just say, that we need to see that alignment really between conduct and convictions. I think that's going to be one of the strong, strong sets of expectations coming out of COP26. And to get to the role really of what the financial regulators can do, I mean, I think it's clear by now, and the science has made this abundantly clear, that we are currently on course to be blowing right through a target of limiting global warming to 1.5 degrees from our pre-industrial levels. And we are heading actually towards an increase well above 2 degrees from pre-industrial levels. And so this means, and I'm sorry to have to remind all of us of this, but, that the scale and the scope of extreme weather, rising sea levels, and the consequences there too that come in terms of damage to property and livelihoods, to species, to communities, to the fact that there will be migrations of people moving across borders. And of course, we're experiencing and seeing a lot of this already. I think we're going to continue to be breaking these records in terms of the event. So we know how costly this is to address these, to address all of this. We also know that it is still far more efficient and optimal to be addressing these costs now. Every day we wait, of course, is a day in which the costs climb exponentially. So I think the realization is sinking in that it's really time to act. It is time to bring all tools to bear to this challenge. And of course, those tools involve tools that maybe many people didn't think could be relevant to the issues of climate change and catastrophe. And those tools are going by necessity, have to involve the financial regulatory tools. And so this brings us in kind of a long-winded way, Cary, to your excellent question, which is that we don't have the luxury really anymore of keeping any potential tool or strategy or tactic on the sidelines. We've got to bring them forward. And we have to figure out the best ways in which we bring those tools forward. And I think that's another opportunity for the COP26, which is to see what it is exactly that these tools might look like. And that's where we are now. To speak from our country's perspective, to speak from the U.S. perspective, we have in our country a myriad financial regulators. We obviously have a central bank. We have an agency that protects investors, the Securities and Exchange Commission. We have an agency that protects consumers, the Consumer Financial Protection Bureau. We have bank regulatory and safety and soundness regulators. We have the comptroller. So we have a host, we have a myriad actually of financial regulators. We have not opted in this country for a monolithic regulator. We don't have a single one. We have a myriad of them, and I think that seems to be the course that we are on in our country in terms of how we've organized the government apparatus in this perspective. But it does mean that we have the opportunity really for agencies to be quite focused on the spheres of the financial sector that they regulate, and to bring a particular perspective to bear on this set of climate challenges. Now, ideally, you have these agencies devise what tools they may have, and then you bring them together. So this is kind of a two-part, I would say, a three-part exercise. You've got to essentially draw the tools out of each financial regulator. You have to then choreograph the tools, kind of figure out what comes first, what comes second, what comes third. And then there's also a very important part that we can't miss, which has to do with the distributional consequences. We can't let the weight of these tools fall on the most vulnerable communities. We have to weigh them and implement them in a way that minimizes the disruptive and costly and disparate impacts on particular communities, namely low and moderate income communities. So that's I'm just giving you kind of the sort of the way in to this conversation. It's a really important part of what needs to get done in terms of getting all our tools on board here as we move forward to tackle this challenge.
No, thank you for that. Fantastic. Just diving a little bit deeper on this first question, and we welcome everyone's questions. We're wanting this to be as interactive as possible. And I fondly remember Dan debating Douglas Holtz-Eakin in 2008, who was McCain's person on the idea of carbon tax and for an accelerated carbon tax over time. And to your point that you just made about the need to make sure that any price on carbon doesn't overly affect those less well off. We've seen the Gilets Jaunes movement in France, for example. How close are we to a conversation on a global price on carbon? Obviously, we have the EU ETS markets functioning well, and in China, the prices are much lower, as well as our regional markets. I'm curious where we are in that conversation, especially with this being Dan and Todd's event.
Right. So I'm glad you raised the carbon, a carbon tax. Carbon pricing is how, I think I'd like to think about this. Strikes me as an extremely important tool. I'll comment a little bit later on sort of where I think it is in the, sort of in the hierarchy of what's getting addressed politically. But it turns out to be a very important, some say a paramount piece of what could be done here to actually move the world's economies to a more sustainable, place of growth and inclusion. Now, the carbon tax, as you point out, Cary, is quite regressive. Okay, and that's a problem. I mean, that is the problem. Now, I don't think it's a problem that means, take it off the table. I just think that in order to move forward with it, it has to be partnered or, kind of conjoined with some kind of mechanism, some kind of fiscal mechanism that would offset the regressive nature of it. And if it were done in that way, so in other words, you would pair it with something or build in some kind of feature that would minimize the regressive nature of it, I think that would be very good. I also think we need to think through the operational ways in which it would work. I mean, we have seen across the pond, for example, attempts at carbon pricing. There have been some stumbles there, but we can certainly learn from those examples and figure out operationally how this could get done. So there's both, I think, this regressive nature that would need to get that would need to get handled, and the also this idea of how do you operationalize it so that it's smooth. But the basic idea is actually really quite powerful, because when you have a cost of carbon, okay, which you determine somehow, right? And I think there are different groups have come up with different prices, but when you have that cost, essentially what you create is the incentive for markets themselves to begin to appropriately allocate capital. Okay, so that's one of the huge advantages, I think, of the carbon cost, and and that would be quite powerful. Now, let me say where I think it is politically. I mean, certainly in the US, it does not seem to be, for example, on the table as a revenue raiser in the Build Back Better discussions, in the infrastructure discussions. I have not seen it in those discussions. Now, it doesn't mean that essentially it's impossible, but I don't see it as one of the discussion pieces. That said, I don't think all is lost. I think that, I would like to hear, lean in a little bit on the financial sector and on firms generally. I think that they can start pricing in carbon. They can start thinking about what that might look like. They could lead the way on that. I don't think that would be, a terrible initiative at all, to see some firms start to begin to consider what carbon is doing, what essentially it's doing, and look at it as a commodity, the way firms look at oil and the way they look at lumber and the way they look at other kind of supply inputs. They could take that same discipline and critical thinking and apply it to carbon. And if they did that, I think that could create some good momentum.
Fascinating. Thank you. Yeah, and audience members, if you have thoughts on this, please do ask questions as we go. There's actually one question that relates to what was going to be my follow-up question, so I'll try to kind of combine them if that's okay, which is there have been rumors that the SEC or some department in Washington will move towards some form of climate-related risk disclosure, whether it has to do with TCFD requirements, Task Force for Climate-Related Financial Disclosure, who's just is in the process of baking in net zero commitments. We've seen this in China as well, rumors of disclosure, but we haven't actually seen these requirements emerge quite yet, other than what we see in the EU. So I'm curious if you have any insights you can share of what we can expect out of the SEC or elsewhere in Washington.
Sure, yeah, and you see, Cary, an emphasis, I think, on disclosures. When you read the report that just came out of the Treasury Department, that was a response to the Biden administration's executive order on exactly this question that we're discussing, the role of the financial regulators in dealing with climate-related financial risk. Disclosure is something that is, within the bailiwick of the SEC. You do see proposals and rulemaking initiatives coming out of the SEC. So the SEC is in fact moving forward. I don't know anything about, dates or, when anything might get launched, but yes, I would perceive that the SEC is in fact leaning quite heavily into disclosure and taking that as a tool that they have within their jurisdiction and mandate that they can be applying. So Disclosure, very important. I would not at all want anybody to come away from this conversation thinking that that's all there is, that that's all that this is about. It isn't. But that said, disclosure does have a very important capital allocation function if it is done well. Query as to whether it is as effective a tool as some other tools. I mean, obviously people have to read disclosures. They have to be meaningful. They have to actually steer investors, in the direction that, that would promote higher returns and lower risk, and that sort of analysis that has, yet to be seen. But the theory of disclosures, I think, is an important one. And you're exactly right. The SEC is leaning into this.
Fantastic. Thank you. Let me kind of flip the conversation on its head a little bit, because there's a lot of talk about climate risk. And for me, one of the things that I think gets lost in these conversations sometimes, I think you've been great at picking at the nuance, so thanks for that, is how do we actually create the investment we need for the necessary transition? And so, there's like a multiple part question here. Maybe we can take this in phases. Maybe part one would be, how can regulators, in your view, better promote more sustainability or, say, Paris-aligned investment through fiscal policy? We see in the EU, for example, taxonomies. There's the role of the MDBs, and then some pushback on the sort of, I would say, purist taxonomy approach of the EU. And I think rightly call for transition taxonomies or transition finance to allow for, say, the developing world or even Canada to achieve meaningful transition without sort of upsetting the apple cart, if that's a fair phrase. Anyway, I'm curious if you have a view on the role that regulators can play to promote more investment where it's needed.
Yeah, and I think that is a very important role of what the regulatory tools can do. They are not, I would say, geared entirely to be punitive or to somehow be essentially prohibitions. They can be imagined really as tools that essentially re-steer, as you put it, kind of re-steer investment through a transition that would essentially actually assist markets and assist the private sector with and assist investors with making the requisite investment. So that is, if you can achieve that, I think that is kind of the, that's the gold standard here. That would be paramount. And I think the way to do it, Cary, is again, I don't think there's a single regulation or a single regulator or a single institution that actually can carry the full weight of this. You point out, the role of the multilateral development banks, the World Bank, the fiscal authorities of various countries, the regulatory apparatus, the central banks. I mean, again, this is a multifaceted challenge. Taxonomies, you mentioned taxonomies. Now, taxonomies, to me, the Europeans, they've made quite a bit of progress on taxonomies. I would say that has not typically been the U.S. approach. The U.S. approach is, to a lot of risk is not always to develop a taxonomy, but to, in essence, take, they're different approach. They take kind of the U.S. starts with like a principle-based approach, looks at risk through categories of, certain categories, and then analyzes the threat or the risk through those categories and figures out then how the risk is to be mitigated. We here, don't tend to use the taxonomies. That said, it doesn't mean that they can't be used. And I think they have to be studied over here because the Europeans have made quite a bit of progress. And we should, to the extent we can, learn from them and see essentially what we can import, so to speak, that would work for our system of regulation. And one thing, I'll tell you, one notion that a taxonomy provides is a notion of standardization. And we are lacking that over here, because if you are going to have accountability over particular goals, emission goals, if you're going to have a sense of milestones and progress, you actually need goalposts and guide signs along the way to help you. And that is the role of a, of standardization or a taxonomy that defines particular terms. So while over here, I'm not sure we're gonna like wholesale adopt, the exact same taxonomy, we should certainly take the spirit of it, which is this idea that we need discrete, well-defined goalposts if we're going to have real accountability here, and we're not going to, be in a world of greenwashing. We do need specific goalposts, and definitions help. Definitions help. Definitions that everybody has to, essentially. We're all, when we talk about, a definition, we all have adopted that as the definition. We're not, we're not saying you get this definition and you get the other one. I mean, a sense of common purpose and common aspiration.
Great. No, thank you for that. Yeah, and just a related question. In addition to not hearing much about taxonomies over here, you don't really hear the phrase net zero all that often. That's starting to change. I think corporates are making net zero commitments, and I assume we'll see more of this next week in Glasgow. But I'm giving a small talk in Glasgow as well, and I'm kind of concerned about the net zero concept being something that doesn't really take into account what we need to do globally. That if pension funds or corporations go net zero, that's great, but what about the developing world? So I just wonder if you see net zero as a useful lens as it kind of relates to this idea of disclosure and taxonomy. I don't know if you have thoughts on this net zero craze.
I do, and I'm sharing some of your some of the sense, Cary, that we have to use this term with some discipline, I think. By the way, I mean, it has been a kind of important rallying cry. You have, as you said, people, firms now talking about net zero, which I think is a sea change from where we were in talking about climate, even 2 years ago, right? So you see a nice momentum that has developed around that net zero concept. So I don't want to fault it for that, because I do think it's been an important way in which firms have been able to, and investors have been able to kind of start to see sort of the power of what needs to get done here. So I'm not for jettisoning the concept at all, but like you, I think there are some caveats that come with it, and we should be careful with them. The one you point out in terms of the developing world, yes. I mean, that is, by the way, going to be one of the big challenges at COP26. And I should also add, preceding COP26, because the G20 is actually meeting in Rome prior to the COP26. And that G20 convening, I think, is a very important and should not be overlooked set of meetings that can be, that can kind of help rein in some of the concepts and some of these issues, some of the fears that we might have with net zero. Another thing I'll tell you, I think about with net zero that I think we need to be careful about has to do with carbon offsets, right? So this idea of net, okay, and how we're going to get to zero with with our current kind of sets of technologies. And one thing that has emerged, of course, is this idea that firms can offset their carbon emissions by essentially taking on activities that are not carbon emitting, that are not carbon emitting, but that somehow change the calculation so that the emissions are netted out because of other activities. And sort of the simple example that comes to mind is, planting trees. Like planting trees is thought of as like, well, I can emit carbon, but if I plant these trees, essentially I have taken out the CO2 that I've put in. That's problematic. Okay, that is not a disciplined and analytically rigorous formulation of what we want to see happen. Because if in fact everything becomes subject to an offset, we're essentially going to see firms continue to emit, and we're not going to see, in essence, the reductions in carbon that we need going forward. So the carbon offset markets, they need work. My own instinct is that you don't necessarily qualify for a carbon offset unless you can't otherwise somehow, reduce your CO2 emission. If you can't otherwise do it, we have to create some kind of standards, then you are allowed to go into a offset market. And that offset market is going to have, obviously certain rules and certain correspondences between what is being emitted and what is being, offset. So I think that's another issue that we've got with net zero.
No, thank you. That's fantastic. It actually, it keys up a couple of follow-up questions actually that have been coming through the Q&A. There are two questions about scope 3, and I'm sure you're well familiar with scope 1, 2, and 3. Scope 1 being the direct emissions of companies, scope 2 basically being purchased electricity, and then scope 3 being all of the indirect emissions. Say Unilever, I think, 2/3 of their impacts are from people using their products, or Ford says 90% of their impacts are the use of their cars and trucks, for example. And so in all of these conversations, whether it's net zero or offsetting or even regulation, how do we think about the fact that for many sectors, these indirect impacts, or scope 3, are often the largest component of what a company might do?
Yeah. And I'm really glad that there have been these definitions, right? So that we can now talk about emissions coming in different categories and in different ways. And I think that this idea of scope 3 is actually very important and very significant. And there are, of course, big debates going on about, how do you disclose scope 3? If you don't disclose scope 3, are you getting really the full picture of what is actually being emitted? And I think you're not. So we've got to figure out, and this is one of the tasks that the SEC has in front of it in terms of disclosure, is how exactly scope 3 should be disclosed, and how and whether or not it's going to fall within, whether firms are going to get some kind of safe harbor or some kind of mechanism that addresses their concerns with disclosure of them. But disclosure is, again, it's only as good as what you're disclosing. And if you're going to take portions of what is being disclosed off the table, you're not really giving investors and others a full picture of what you're doing.
Thank you. Yeah, and the other related question to your previous comment on the G20 meeting in advance of COP26 it gets to the heart of something that I think is super important, which is how do we actually maximize international cooperation and collaboration around climate change more generally? That this is one of the questions that's come through. This is the 26th time we've done the COP process. At what point do you keep going back to the well and not getting the result? I mean, personally, I don't really understand why we're even bothering. I've been saying this for 10 years. The UN framework is one that requires every country to agree on whatever it is that comes out, right? That's basically the rule. Rather, why aren't we creating sort of a consensus to act amongst corporations, investors, people, which are 2/3 of the global footprint, or Generation Investment Management estimates 60%. Certainly the majority are people and their choices, let alone innovation and research, such as we do here. And then policymakers should be supporting that yet we're sort of asking for these country commitments as opposed to like maximizing what companies might do or what investors might do. So I don't know if you have a thought on how we can actually maximize international cooperation. And I just think about Asia being half of the world's economy, and with all these ongoing conversations about differences of opinion, do you have views on how we can maximize international cooperation, which is the last of the 17 SDGs, in some ways, maybe the most important?
Yeah, and I agree with you. It can feel super frustrating in terms of bringing countries together and being able to make progress. And of course, we saw, just this week, China feeling essentially it's got to ramp up its coal production now in light of the fact that it's facing particular energy shortages. And this kind of, and you've got India also, making statements that, it's not prepared to be able to, sit down at the table here and move forward. And that's hard, that is hard. And I think, though, in a way, we have no other choice. I mean, we have no other choice but for, your suggestion, which I think is a powerful one, which is essentially, business enterprise, business leaders, the private sector can lead on this, can push governments. I mean, that is important, not just business leaders, I would say investors, I would say activists. These are all, very engaged individuals and organizations that can put pressure on governments to actually do more and sit down and hammer out deals. Certainly in the absence of it, you can imagine nothing happening. I mean, the fact that we are where we are today on climate, and yes, it's a hard, we've got a hard course here, a hard trajectory ahead of us. But if you look at the last year, there's actually been really magnificent kinds of momentum here. And I would argue it has come from a combination of the kinds of individuals you're pointing to and the organizations you're pointing to. It has come from activists. It has come from investors. It has come from business leaders. And so that kind of leadership are pushing governments to cooperate. So I think that's where I think you got it, Cary. I mean, I think that is where it's going to come from. And I don't think that's a bad thing. It's not a bad thing at all.
Yeah, no, thanks for that. We have a number of other questions that have come through. I would encourage the audience to ask questions of this fireside chat. We certainly welcome them. There's a number of specific questions. So one has come through on what are the most relevant aspects that we might think about when it comes to disclosure? This idea of how do we understand whether companies' commitments are legitimate when it comes to reducing greenhouse gas emissions? Is it capital expenditure, or the timing of that expenditure, or expenditure, perhaps maybe it's something else? If there is offsetting, how much weight should be put on different impacts that might occur? And there's sort of a related question about sometimes we have people trying to do carbon offsetting, and then the forest can burn down. So how do we sort of deal with all of these complications in what we're trying to achieve?
Yeah, well, thank you for that question. And all of these, I mean, first of all, the questioner is pointing to a very important challenge, which of course is that, our ability to decarbonize is only as good as our mechanisms to achieve it. And so disclosure as one of those tools, you can imagine it being a complete sham and a nothing burger. And you can also imagine it having some real power here to turn the tide and turn the trajectory. And I think it's going to depend not so much on on, should it be expenditures? Should it be risk? Should it be, should it be plans? What essentially gets disclosed. But I think there needs to be standardization. We need essentially, by the way, when I say standardization, I don't mean one size fits all. I just mean some definitions around what exactly we're comparing, so that investors, when they make decisions regarding where to invest, they can look at one firm and look at that firm's set of disclosures and know that when they look at the same things in another firm, that's comparable. So the ability to compare, I think, is important. And to get there, you need some kind of definitional framework, some attempt at standardization, certainly for firms that are in the same industry, right? And you might have different disclosure regimes for different industries. I happen to like the, I happen to like the idea of firms disclosing in a standard way their decarbonization plans. Now, when I say, I don't mean like everybody just throw in a plan and whatever it looks like, you've checked the box, but to have some templates really that are applicable to different parts of the, different kinds of firms, so that investors who are looking to decide where they want their dollars to go can actually compare most nimbly by looking at a firm's decarbonization plan, with milestones and with, particular sets of actions. And I think that would be a very important first step. In terms of capital expenditures, I don't know. I find that one possibly a little less able to, from an investor perspective, be able to, compare. One firm can be spending tons because they're in, tons of money because they're actually not, they haven't done anything and they got a lot to do. Doesn't necessarily mean that firm is essentially a firm that, an investor is going to think is leading the way towards, a decarbonized, world. So I think the metrics that we use should be chosen, but once they're chosen, I think they've got to be essentially the metrics that apply to almost all firms. You can make certain gradations, but you want something to permit investors to compare if you're going to really use disclosure as a way to allocate capital.
No, thanks for that. A really interesting follow-up related question has come in from, I believe it's Tim Dunn of Terra Alpha, but I can't tell what organizations people are posting questions from. So Tim can tell me whether it's the Tim I know, but regardless, really interesting question. If you're corporations are global, right? So multinational corporations might end up having sort of different regional standards to possibly disclose to, whether it's the EU taxonomy or whatever the SEC eventually requires. How does that potential complexity come into play going forward, where we might have different regimes with different disclosure requirements for global corporations?
Yeah. So obviously that is a challenge. A lot of global firms that operate across jurisdictions are really quite used to different disclosure regimes on all sorts of risks. So, while I'm not, I feel the pain of having to, have different, have different kinds of requirements to comply with. I also know that firms do this. They do know how to do this. And until we actually create a harmonized disclosure regime, and by the way, let's try to do one that's harmonized. I mean, if we could get there quickly, I would say, yeah, let's move towards it. That obviously would be terrific, because it would certainly help large firms comply better. That said, I don't think it should be holding up the basic set of imperatives regarding getting some momentum here on giving investors the ability to be able to make these comparisons. I should also say, it's a good opportunity because there's a lot, there are multinational firms. There's also a lot of local firms, a lot of startups, a lot of firms doing fantastically innovative things. At this point, they're not multinational, these are not technologies that are yet scaled to a place in which they can cross jurisdictions and borders. And those firms, I think, are just worth also a shout out, and they need to be encouraged in terms of their ability to be able to scale up and be able to actually strut their stuff. They are doing fantastic things. They have the potential to be doing amazing things for decarbonizing the planet. And let's give them an ability actually to show what they're able to do and attract capital.
Yeah, I couldn't agree more. Actually, I'll shout out Sophie Purdom and Kim Zoe, who I introduced to each other and have started the free newsletter Climate Tech VC, which has become a major phenomenon in how capital is moving towards innovative ideas. If you haven't seen it, I'd recommend it. It's great to see young women empowered to make a difference, as far as I'm concerned. And actually, there are two more questions that I think I can combine that sort of relate to what you were just saying also, which is, in your opinion, what would be the most effective government policy that we could enact to really achieve momentum towards, quote unquote, net zero in the United States by 2050? And, or do you see gaps in the regulatory authorities that might need to be filled in order to achieve that sort of emissions reduction?
Yeah. Okay. So, I got to tell you, I wish there were kind of a silver bullet here from a regulatory perspective, kind of a one magic, thing that can be done that would essentially just completely, permit us to move into a different trajectory towards carbon reduction. I wish. Okay. I don't think there is one. And that, believe me, if there were, I would, it would be great to be, organizing around it. And by the way, that isn't to say that one won't emerge, but we still are at the stage where we really have to roll up our sleeves and be putting on the table absolutely everything that could get contemplated. Okay. I don't think there has been any consensus that disclosure is going to be the whole thing. We haven't talked about, for example, stress tests or capital weights or concentration limits. I mean, there are a whole host or green mortgages, right? Different underwriting standards, there is so much, Cary, that we have not yet explored, that for us to now say, this is the way to go, I think would be we're just not there yet. We can't do it. Now maybe we will get there. And what I'd like to see, of course, and we have seen this at times, it's a kind of sort of a virtuous cycle, as opposed to a vicious cycle, a virtuous cycle where where different players, different agencies, different parts of the private sector begin to kind of build slowly towards working on these problems. And then you can kind of have a sense of momentum where actually things then emerge, better ideas come out, refined ideas come out. And then you can have almost this paradigmatic moment where something catches as wow, this is going to be our way forward. We're not there yet. We are just not there yet. We are just, I would say, certainly in the US, we are just beginning this exercise of bringing all the tools, all the opportunities to bear. So that said, let me say, in terms of your question about regulatory gaps, by the way, what I'm talking about in terms of how the financial agencies participate in kind of showing their stuff, showing what they can do. In the context of doing that, you learn what they can and can't do. So when you see that there are things that they can't do for reasons of legislation, you put them in a stack. Okay, you put them over here. You say, okay, that's going to require legislation. We will deal with that when we deal with legislation. But guess what? We have a stack like this that's this high on things that we can do without legislation, right? That we can be moving forward with right now. So I think that's kind of one approach that we should take. Like, do not let the fact that some things require legislation hold up everything that can be done without legislation. And there's a deeper point, which you also raise, which is this idea of shadow markets, right? Of course, that there's a sense of that despite the entire, federal regulatory coverage of the financial sector, there are big pockets that have no kind of federal oversight, and we have to do something about them. These are the so-called shadow markets. If dirty assets are just going to get pushed out of the sort of regulatory purview into an area that is not overseen at all, that's a problem. That's not, that's almost like that's like a bad offset, right? Essentially, you've just transferred these assets to a place where they continue to create emissions and nobody's looking out for them. We have to do something about that. That is obviously a gap that is going to have to get addressed. I'd like to think, by the way, that some of that gap can get addressed with the current regulatory structure, but not all of it. I would not say all of it can. So we've got to figure out how much of it can, how much of it can't, and then and then decide what needs to get done legislatively.
No, thank you for that. You very eloquently stated why I'm so against the divestment movement on fossil fuel publicly traded companies. It makes my head hurt. If anyone has a question on that, throw it in the Q&A. We'll take that. We'll take that one on. But I think you explain why that's arguably a futile exercise. Which relates to another question I have, which is about the importance of education. Here we are at Yale, and I read an article yesterday in Vox that 45% of Americans don't believe humans cause climate change. So for all of the climate philanthropy that goes on and divestment movements and whatever it is, NGOs, papers, think tanks, COP26, shouldn't we be paying more attention and effort to build a consensus among the average person as to what's needed? And why haven't we done that? And how can we do that better as educators?
Yeah, no, that is a really important component to dealing with this challenge, because of course, if everything is done, say by government mandate, or essentially, sort of, without kind of connecting in to communities and connecting in to the populations that are going to have to be confronted or could bear the brunt of some of this, some of this transitional cost, that's not going to work. It is not going to work. I mean, it's certainly not fair, but it's also not going to have any traction to it, because people are going to be put under so much duress and pain that they're not going to put up with having to deal with higher costs that are going on and on and on for as long as they can see. That is just not going to be that's not a sustainable policy. So the role of education, I think, is extremely important. I don't think it has to be done or should be done in kind of the conventional way of, requiring people to go to, places like Yale to be and taking courses in climate. I mean, we have to be much more imaginative about how people understand the costs that they are confronting right now. I mean, for example, with renewables, by the way, I mean, people who have solar panels right now, if they've been able to put in solar panels, they are actually not dealing with the higher energy prices that a lot of other households are dealing with, right? So that's kind of an interesting, phenomenon. There are people who have made investments early on, and they've had access to to kind of quality solar panel, important battery power work done that has permitted them to actually start to reap savings in times like now. And those kind of stories, I think that's to me what I think would be like a kind of an interesting educational effort, is to hear from people who have made these decisions. How hard was it? How hard was it to finance a solar panel? How did your town help? Was the company helpful? Do you understand how to use them? Are you seeing how long did it take for your bills to come down? I mean, those to me are kind of the kinds of education I would like to magnify, the kind of stories that I think we need to be highlighting. And then I think you'll start to see a sort of a transmission of understanding as to what's going on here.
No, thank you. I know Dan's also an advocate for the affordability of solutions that we need. Couldn't agree more. With that said, maybe one last question from me, which would be just tapping into your expertise when it comes to the role of central banks in the transition on a global basis. Like, what would be your dream scenario where we have this NGFS of global central bankers led by Dr. Ma Chun, partly out of China? What can central banks do together globally, whether it's accelerating investment in the developing world or creating the right incentives, the right mechanisms? You must have given this some thought. I'm sure you have some suggestions.
Yeah, so you're right to raise it, Cary, because central banks really can do quite a bit. And I think through these convenings, the NGFS being the notable one, central banks are able to convene and to share ideas. And I know, they all have various mandates. They all, that are different. They're not identical. And, they have different minor ways in which their missions might be different and how they're organized. That said, they all, as far as I know, I think it's safe to say they all really have both a set of powerful tools that they can bring to bear on a macro sense, in terms of setting the conditions that need to be set in the economy. They have regulatory tools. They have the tools of being able to intervene in markets, as we know. And they have all very important stewardship responsibilities. So let me say something about each of these, both about their ability to intervene during crises. We've seen this, with the Fed using very imaginative efforts, both in terms of the response to the financial crisis and in response to the pandemic. We know the Fed has heavy duty artillery, right? And we also know that artillery is not a fine-tuned artillery. It's, these are the big weapons. They are not the weapons that are able to sometimes distinguish between, one sort of challenges and another, but they exist. Quantitative easing. This is a tool that the Fed and other central banks, the ECB and the Bank of England, deploy. Those tools could be reimagined. We have another risk, that we are confronting. What do these tools mean in looking at those risks? And I think the NGFS is an interesting forum to be exploring those almost kind of, break the bottle kind of discussions. But I remember when, quantitative easing was a break the bottle kind of, solution. And now you see quantitative easing being just part of the regular arsenal. It was used extensively in the pandemic. So what do these tools mean in the context of this extraordinary climate set of challenges that we are in the midst of right now? And then to the monitoring and the stewardship. All central banks are, ultimately tasked with being the almost final, stewards of our economy. And we are in the midst of an economy that is transitioning. We are transitioning from one that is carbon-based to one that is renewables-based. And that transition is not going to happen overnight, and it's not going to happen simply. And optimally, it will not happen with a lot of fire sales and unexpected turbulence. The Fed plays a very important role in assuring the financial stability of that transition, of making sure that as we maneuver through these really tumultuous waters, that essentially we have somebody holding the rudder here who is absolutely skilled and expert at helping maneuver through and minimize the turbulence along the way.
Thank you. Yeah, central bankers have an enormous role to play. It'll be fascinating to see how this unfolds. Maybe one last question as we're getting close to the end. I'll try to combine two questions from the audience. One is, from Lawrence Baxter. I think he shouts out your call to not just divest from assets and have them go into a non-transparent mode. But then the question is, what should university endowments actually do to be most constructive when it comes to climate? That's sort of part one of the question. Part two is this ongoing yo-yo effect of the Department of Labor and ESG that's been going on. We actually had the chance to interview Mark Mobius, a famous investor, used to be at Franklin Templeton. He was Asia's largest investor in many ways, often owning 5% of companies. And how can the U.S. government tell investors what to do when it comes to investing in a region like Asia and ignore something like corporate governance? I mean, it just seems to be a non-starter. Why are we even having that debate? I'm puzzled by that. He was surprised. He didn't even know that was the case. He was shocked. Shouldn't that be a non-starter conversation? And more importantly, what advice do you have for investors as to how to deal with these back and forths?
Yeah, well, I've got to tell you, these are excellent questions that, of course, Lawrence is just so adept at articulating. Thank you, Lawrence. I got to say, these are the kinds of questions I ask Lawrence. I mean, he is the go-to on certainly on questions on endowments. And I want to say that you have seen significant work done, certainly the Yale endowment, the Harvard endowment, I think Duke under Lawrence's, able direction, other colleges and universities really grappling with what is in their portfolios and also wanting to exercise their muscle to the extent they feel they have it, to be able to send to their, to their investors, really important signals about what they want to be, what they want in their portfolios. I really do applaud here. I give a big shout out to the work of the Sunrise Movement for actually focusing on a lot of the work that endowments do. Endowments, by the way, I should say, while a lot of them have made important pronouncements of late, you got to read those pronouncements carefully. Some of them are signaling and some of them are actually making change. And I think that it's important to kind of parse through what is actual signal and what is actual change. By the way, I don't diminish the importance of a signal. Signals can be important as well, but sometimes they can be just symbolic and may not represent a real change. As for the question about U.S. government and the labor, the federal workers who should have a complete and total say in the choices that they make. To be taking these choices off the table, like you, Cary, that just confounds me. There is just, I don't get it. I don't think that that's what should be essentially considered optimal. We are, there are investors here who have, earned money through many years of service at, say, in a government capacity. They are making important decisions on their investment portfolios, and why you would essentially take away options for them is, to me, suggests a kind of a politicization or a weaponization of investment. Which we should not be doing at all. So I'm with you on that. I think it's really problematic. And as a savvy investor, and you want choice. You need to have choice, and to limit choice is certainly not optimal.
Well, speaking of signals, I think we're at our time. I really enjoyed our time together. Sarah, thank you so much for joining us. And everyone should thank Sarah Bloom Raskin for giving us some of her time. And with that, I think we'll turn things over back to Dan.
Cary, thank you so much. Sarah, thank you for a great conversation covering an enormous amount of ground. And it does come to me to close us out. And frankly, the whole day brought so many issues to the fore that I won't dare to try to summarize. It really was a rich discussion across a wide range of topics, a great set of conference papers, which I look forward to putting into final form. But I will say that certain key concepts did emerge, several of which we just heard as Cary and Sarah were talking. But I think the terms of the day, or the words of the day, might be transformation and transition. And I do think what also came through with great clarity is that there is an emerging consensus with regard to climate change that we are going to need deep decarbonization. I think generally there is a sense now that's defined as net zero greenhouse gas emissions globally by 2050, but that means that a significant number of countries and companies will need to move faster than that. And I think we really did do a very nice job in the conversations, the keynote conversations, as well as the panel discussions, in thinking about some of the policy tools that will be required to make that happen. And it is a big deal. It's going to require incentives. It's going to require inducements, but also perhaps push as well as pull, because we are expecting to need a business model transformation in every sector of society, and virtually every company as well. And we heard several people say, and I think it's another theme of the day, that this all has to be done with an eye on not jarring people who are at the low end of the income spectrum, who are otherwise entitled to some policy attention in support of what would be called a just transition. I think the other theme that I saw coming through loud and clear is that we can't rely on government entirely. A lot of this will fall on the business world, and beyond that on the world of finance. Clearly, one of the central questions is whether we get beyond the vision that will come through at the COP26 in Scotland over the next 2 weeks, the vision of deep decarbonization, but how do we translate that into a strategy and an action plan, not only at the government level, but company by company, industry by industry. And we need, of course, not only to have a plan, but then to have that plan executed. So I think tracking implementation and really watching whether the kind of capital flows required to fund this transition are occurring is a big deal. And what it will take to make that money flow is something that we really did get into, and I hope we'll spend more time on in the weeks and months ahead. Some of the tools that emerged clearly are the ESG metrics that companies are increasingly being asked to report on, their environmental, social, and governance performance. I think beyond that, we did have a significant discussion today around how that in the climate change context comes in close on the question of what is a company's net zero greenhouse gas game plan. Has the company made a commitment to a net zero greenhouse gas future by 2050 or by 2040? But we need to have, as Sarah just told us, discipline on that structure of those pledges and what's really entailed and what's involved. And I do think it's also clear that we're going to need to focus on climate change in a very big way. That's what's front and center as the conversation in Glasgow heats up over the next 2 weeks. But there is a broader sustainability agenda that's required as well, what I've been calling the sustainability imperative facing society, which has climate change as a critical issue, but a whole set of other issues: air and water pollution, waste, biodiversity on the environment part of that agenda. But then, as a number of speakers told us, there's a big S, or social agenda, as well, around diversity, around inequality, around racial justice. And it seems like the corporate world is very much aware now that those are parts of the story that can't be ignored and need to be addressed. So all of this does say we've got a big agenda in front of us. One more theme I guess I'd like to put forward is that in addition to recognizing it's a broad sustainability agenda, we can't simply focus on what's being done in the developed world. The key to success on a number of these issues, climate change most notably, is actually going to play out in the developing world. And therefore, the flow of capital, not only to the kinds of infrastructure investments required for clean energy in Europe or North America, are going to be important, but the flow of capital to the developing world to ensure that the emerging energy infrastructure across the whole world does have that clean and renewable foundation for it. Now, I do think for those who are academics or interested in the underlying analytic work that was shared in a number of the papers today, it's very clear that we need more of that effort, more analytic rigor, more careful analysis, really recognizing a number of elements here that I think came through. The importance of the role of regulators, of some degree of comparability in the kind of ESG metrics that are reported. And I do think there is a risk that a couple of people have mentioned that the COP26 moment will set us up with perhaps new momentum, but maybe not even, but it probably won't get to the level of detail required to really drive this agenda forward at the speed and scale that's necessary for deep decarbonization in particular, but to address the broader set of sustainability challenges as well. So I do think we've got a number of things that are highlighted in terms of where further work is required. It's quite clear that the agenda is large for governments, but there's also a lot to be done at the corporate role and the corporate sector, and frankly, beyond that, in the NGO arena. And I think the world of finance comes into sharp focus in terms of what is expected and the important role that asset managers are going to play in this process of moving towards a sustainable future broadly, into addressing climate change successfully in particular. So I will close out there, and I want to first say a huge thanks to both Hanneke Smits and Sarah Bloom Raskin for their contributions today. Really wonderful presentations, both of which covered ground and gave us a lot to work with in terms of the issues in play. Second, I do want to thank our sponsors, our platinum sponsor, BNY Mellon, a great partner on this project, and frankly, the Gordon Family Foundation, or Roberta Gordon, also critical over many years and for this event today. And we also thank BNP Paribas for their sponsorship. Without all of these, we wouldn't be able to do what we've done today, and we all owe them a debt of thanks. I also want to thank the Yale team that's worked behind the scenes, Nathan de Arriba-Cellier, Tyler Yergain, and then a broad set of research assistants who've been working not just for days, but for weeks, and in fact, in some cases for months, helping us pull together all the pieces of what came through across the Zoom screen today. And finally, let me just say thanks to all of you. I'm really grateful that so many of you stayed with us to the end. The conversations were rich and valuable, and I'm thankful for all the questions that you put forward. And I really do hope that a number of you will be with us next year in New Haven. Thanks so very much. And for that, we close out. Thanks again, and look forward to seeing all of you at some point live in the coming weeks, months, and next year in New Haven. Bye-bye.